You pay zero federal income tax spending $150,000 a year in retirement. Hi, this is financial planner Sean Mullaney. Let's discuss. So I actually have not one, but two potential ways that someone spending $150,000 a year in retirement could pay zero, and I mean zero, federal income tax. And the way I'm going to demonstrate this academically, right, not advice for your own situation, is by laying out a profile. Let's imagine Jane and Joe, and they are a 66-year-old retired married couple. And they have almost $3 million in financial assets broken up as follows. They have a domestic equity index fund, broad-based, in a taxable brokerage account. It is worth $750,000. It has a $375,000 basis, a 1.6% yield, and of that dividend, 94% is the so-called qualified dividend income. 6% is attributable to REITs, so it's a 199A dividend. Okay, so that's their taxable brokerage account. Now, they also have various mutual fund holdings, $2 million in a traditional IRA or IRAs. Of course, that's tax deferred. We'll talk about that later. And then they have $200,000 in mutual funds in Roth IRA or IRAs. They have a savings account. It's just $10,000, has 5% interest, and they have a paid-off primary residence. So they're certainly an affluent couple, doing great, not wildly affluent, but doing just great. And they want to spend $150,000 a year on their personal consumption, right? That puts them in a pretty good place. Remember, this is a couple that's not commuting to work anymore. They are not paying payroll taxes anymore. They don't have a house payment anymore. So if you're spending $12,500 a month in retirement, $150,000 a year, you're probably taking one or two really nice trips every year. You are not miserly by any measure, right? You're doing just great. Well, all right, but you say, well, wait a minute. If they're spending $150,000, they're going to pay some federal income tax. Well, let's look at one path that they could get the $150,000 and see how much tax they'd actually pay. First path I'm going to lay out is they're going to take from those traditional IRAs $30,000, and then they're going to sell $120,000 worth of that domestic equity index fund. That's $150,000 that they can then use to fund their living expenses for the year. Great. Let's start mocking up their tax return, at least in Google Sheets. Interest income is about $500. About $600 in something called Section 199A dividends. Usually that leads to a very small tax deduction just because of the technicalities of the way their numbers work. They actually don't get that very, very small tax deduction. Don't worry about that. They have the $30,000 in taxable traditional IRA distributions, okay? About $9,500 in qualified dividend income. Now, this is a big one, $60,000 of long-term capital gains. Remember, when you sell $120,000 of a mutual fund, is that your taxable income from the transaction? The answer is no. The way you figure out your taxable income is you take the proceeds, 120 in this case, and then you subtract out the basis. And recall they had $375,000 of basis, basically 50% basis, 50% gain. So when we do our tax return, only $60,000 of the 120 shows up as long-term capital gain. That is very, very powerful. All right, but let's keep going. We have adjusted gross income of about $100,000. That's fantastic. And then as a 66-year-old married couple, they get two deductions. They get the standard deduction, 2024 numbers, $29,200. They get the so-called additional standard deduction of $3,100. Okay, great. That puts their taxable income at a little over $68,000. And guess what? They pay zero, and I mean zero, federal income tax. Well, how the heck could that be possible? Well, let's go to the tax computation. And this leverages off something called income stacking. The way federal income tax works is it says you have two different types of income, ordinary income and then long-term capital gain income. And the way we tax is we first tax the ordinary income, and then we throw on top of that any long-term capital gain income, which happens to include qualified dividends. And so this works out very favorably for Joe and Jane in my example. So they have $31,105 of ordinary income in my example, the $30,000 from the traditional IRA, the $500 of interest income, $605 of a 199A dividend. Well, you say, oh, that's taxable, right? No. Why is it not taxable? Because it is all sheltered by the standard deduction and the additional standard deduction, which is more than the $31,000 and change that those three things create. So what we just did is we took $30,000 from our traditional IRAs, we lived off it, and we paid zero federal income tax. Now that's what I refer to as a hidden Roth IRA. We literally took money from a retirement account and we paid no tax on it, right? Ding, ding, ding. Isn't that a Roth IRA? Well, it's what I refer to as a hidden Roth IRA. It's a fantastic planning opportunity. That is just great tax planning. And oh, by the way, that $30,000 to live off of tax-free reduces our future RMDs, giving us a tax benefit in our 70s and our 80s to boot, right? We are just cooking with gas here. But then you say, well, wait a minute, Sean, they had almost $10,000 of qualified dividends. They got, whatever, $60,000 long-term capital gains. We got to pay some tax on that. No, we don't pay tax on that either, right? So what happens there is we stack that income on top of the ordinary income, and we still don't get to $94,050. That's the number for a married couple in the year 2024. If their taxable income doesn't get to that $94,050, they don't pay any federal income tax on long-term capital gains and qualified dividends. That's so powerful. This income stacking works so well. So this couple, they spent $150,000 as a retired couple, and they paid no federal income tax. This is cooking with gas. This is incredible. Now, this party won't last forever, but it can last for a few more years. What's going to eventually derail this party, it won't be that bad, but eventually they're going to run out of the taxable accounts and they're going to have to take Social Security. We'll come back to those two things a little bit later, but this is a great party, and this could be multiple years worth of this great party, and it's in their mid to late 60s. So it's some of their best retirement years. They can live it up and not worry about federal income tax. How great is that? Now, I do think this couple could do it a little bit better, right? So what this couple could do, instead of what they just did, which is phenomenal, right? I don't mean to be a critic, but I do think we could make it just a little better. And how do we do that? What this couple could do is they could say, well, wait a minute. What we're going to do is we're going to live entirely off the domestic equity index fund, right? We're going to sell $150,000 of that instead of $120,000 of it. And then separately, we're going to do a $30,000 Roth conversion. We're going to move the money from the traditional account, retirement account, and not take it to live off of, but simply Roth convert it, put it in the Roth IRA. That's quote unquote taxable. We'll get to that as well. The big advantage, assuming we can still keep it zero income tax, is the money would stay in retirement accounts. It would be in a Roth IRA. If we do this 3, 4, 5 years, it could be over $100,000 in Roth IRAs. And we get some additional creditor protection because it's not in a taxable account. We're spending down the taxable account sooner. But I mean, either way, it's fantastic. I still like this version better as long as we can keep it tax-free. And I think you'll see, guess what? The income looks very similar, other than the long-term capital gains happens to be significantly higher. It's now $75,000 instead of $60,000. But the way the numbers shake out, it's still federal income tax-free. So I do think this second route is a better route. Look, on the creditor protection thing, umbrella insurance should always be in the picture anyway. But boy, if we can get $100,000 in our late 60s in a Roth IRA tax-free, I think we ought to do that. But that said, even if they chose to go with the first route, they're still cooking with gas. Let's take a look at the tax computation here. And all the numbers still work out very similarly, where we're going to get to a place where even with $150,000 of living expenses and a $30,000 Roth conversion, we are paying zero federal income tax. Why are we so worried about these traditional retirement accounts, by the way? If we can do zero tax rate Roth conversions in our mid to late 60s, assuming we have some taxable accounts we can live on, that's a pretty good place to be. So this is very powerful, right? It's not a guaranteed outcome for anyone, but that this is at least theoretically possible, I think has a lot of really good implications. obviously it means that retirees tend not to be heavily taxed in retirement, which is something I've said several times on this channel. And this is more proof of that. One of the things that it proves is it is great to have taxable accounts going into retirement, right? This strategy doesn't work if the only thing this 66-year-old couple has is the traditional IRA. Now, they're still going to be okay, I would argue, but yes, this strategy is hypercharged because they've got that capital gain income they can largely live off of. It's so efficient. So people worry about, wait a minute, that's a taxable account. I would argue, why not take your deductions into your traditional 401k, take home more money because of that, and then have money to invest in these taxable accounts to set up this cooking with gas planning in your mid to late 60s. All right. Second implication is this. Why are we so worried about traditional retirement account contributions during our working years, right? You're going to see content creators out there saying these traditional IRAs, these traditional 401ks, they are infested with taxes. Well, wait a minute. We could do a $30,000 Roth conversion tax-free in multiple years in our mid to late 60s, and you're telling me that's infested with taxes? Really? I got that out of there at a 0% tax rate, and I took a deduction during my high earning years at work. That's really good tax planning. So look, I'm not here to say that Roth contributions at work are never the right answer, but boy, this is a real advantage of take those deductions at work today during our accumulating years, and then when we're in our mid 60s or mid to late 60s, we bail that out at a very low tax rate, maybe a 0% tax rate. There's also a very forceful argument to delay claiming Social Security. And look, in this video, I can't give you your own claiming strategy. And I will say, if you need the money at age 62, you're no longer working, yeah, it probably makes sense to take the Social Security when you need it. But if you have taxable accounts you can spend down, it's a very forceful argument. Hey, delay that Social Security, right, which increases the amount you get every year later on and provides a longevity benefit. If you live a long time, it provides a portfolio benefit from a volatility perspective because less of your portfolio is taxable as brokerage accounts, more of it's Social Security. It's a less volatile asset. Boy, this is great. If this couple was taking Social Security at age 66, it would very severely dampen this planning, and they almost certainly wouldn't get a 0% tax rate. So it's a forceful argument. Like, if it's going to be a bigger check by delaying anyway, why not delay and do this very good tax planning in our mid to late 60s? And then lastly, tax basketing. They had $750,000 in a brokerage account. In theory, that could have generated a whole lot of taxable income, $30,000, $40,000, if that was, say, invested in a bond fund instead of a domestic equity index fund. Now, I'm not giving you investment advice in this video, and it might be this couple, Joe and Jane, age 66, wants to hold bonds. Well, that's fine. You know where you could hold bonds really tax efficiently? Traditional 401k, traditional IRA. It's deferred ordinary income. You get at least some deferral on it. Why not hold the bonds inside the 401k or the traditional IRA and then hold the equities, which are low yielding and, as you saw, very tax advantaged through the qualified dividend income mechanism? Why not hold that in the taxable account? So these four implications, there's so much on the table here. I think part of, you should come back to a video like this the next time you hear, oh my goodness, retirees are taxed to oblivion and there's going to be all these taxes in retirement. I think it's very possible that someone could be very affluent in their mid to late 60s and pay 0 federal income tax. Let me know what you think in the comments below. Thanks so much for watching. Hope you enjoyed this video. If you did, please smash that like button and subscribe to my channel. I'll see you next time.